We're here at the LBMA in Vienna, and our next guest is Neil Meader. He's the director of Metallis Consulting, and he joins us now. Neil, good to have you on the program.
Thanks very much. Good to be here.
So I know you spoke earlier this morning. You were on the panel with Jim Steele. So of course I want to start by getting your sentiment on gold. Are you on the bullish or bearish camp here?
Neither. I think we could be in for an extended period of quite sideways pricing. I think one of the key themes that we're looking at, it's really quite difficult to get too bullish if you're looking in the face of interest rate rises. Right. But I think one of the key things that I wanted to bring out is that over the last 10 years or so, we've had a huge build-up in institutional investment. And I think what could be critical to the market is the pace at which they potentially sell that back. I mean, it's difficult really to justify continued investment with those rate rises. But I think what's interesting is that the market is insulated from those huge stocks by the so many unknowns in the market. It's those black swans. I mean, what's going to happen to China in the medium term? Is the S&P overvalued? All this crazy hunt for yield, I mean, people pushing into quite exotic areas, the emerging market debt. There's a whole lot of time bombs, potential time bombs out there. And why sell an insurance policy if something could go bang in the next couple of months or a year or so? And I think if we can sit on those institutional stocks and let it slowly deflate over the next few years, just as we're seeing the fundamental deficit really start to grow and open up, then I think we could see a quite dull market, and I think to an extent that's the best outcome. I think we could see a lot more price weakness if those black swans prove to be a non-event and institutions start selling that much more quickly.
And also in Q2, we saw demand fall to its lowest level in 6 years coming out of China and India for gold. Does that must play a factor as well?
Absolutely. I mean, we looked as if we'd got stuck in a range sort of 1170 up to 1250. Then as we moved into Q2 and the emerging markets kept underperforming, that range seemed to have sort of slipped back in sort of, I don't know, 1100, 1170. And I think it might be difficult really to shift back to the earlier range unless we do see some more positive numbers coming out of India and China.
So Neil, let me ask you, we're almost at the end of the year, I can't believe it, but what price would gold need to close at, finish off the year for you to say, perhaps there's a turnaround coming?
A turnaround to the upside, I guess we'd have to be at least 1250, because that would signal that we'd really broken out of that old higher range. I think now if we're looking at the new sort of lower range, I think if we had a decisive break below 1100, you see a lot more technical selling and sentiment really changes, and couple of interest rate rises coming through, that sort of thing, break below 1100, and then I think we could be in for maybe more weakness, but I see that as unlikely.
So which metal do you feel has the most upside potential as we start 2016 of the precious metals?
Right. Well, I guess the cliche is palladium. The fundamentals are always on its side. Right. The recent diesel thing really hasn't done platinum any favours. Silver's done very well of late, but to an extent I do worry that some of its industrial demand could be threatened by some price-led thrifting, because you have too high prices, say 2-3 years ago, and it takes that long for the new technologies to come in. So even though we're well off the peak for prices, it's kind of now that the substitution really starts hitting demand.
Neil, on that note, thank you so much for being with us.
Thanks very much.
And thank you for watching our coverage here from the LBMA in Vienna. Thanks for watching.